I think I'm just going to give a very quick numerical example of what I was talking about in this process here. I'm just going to display it in a different way. So we have three banks, alpha, beta and gamma, and there is actually a bank alpha, a Greek bank. I don't know whether it's still around. Alpha, beta and gamma, okay, and they all exist separately. And chap comes into bank alpha and he deposits 100 ounces of gold. And what would happen at that stage is that, and he says, I want to keep it on demand. I want to keep it all on demand, okay, at Bank Alpha. And Bank Alpha says, well, it costs me money to store gold, so that's 12 basis points per annum, something like that, to have your money on demand. And I'm sure there are enough people in here who can remember when demand deposits didn't pay money. Or checking, what are they called? Checking accounts in America? Yeah. You know, they're not meant to pay money because your money is available whenever you want it. Okay, so our chap says 100 ounces on demand, and at that stage, the Bank Alpha will have 100 ounces in liabilities out, and 100 ounces of assets. What will be the form of these assets?
Gold.
Yeah, gold coin. Okay. Now, our protagonist says, okay, I only want to keep 20 ounces on deposit, and I want to lend 80 ounces out. So Alpha Bank goes, Bank Alpha goes, okay, fine. So, you know, liabilities turn to 20 ounces demand, and 80 ounces. Well, first of all, Bank Alpha says to our chap, how long do you want to lend the money out for? And he says, it's irrelevant. He doesn't say that, no, it is irrelevant. Say 1 year, okay, so he wants to lend it out for 1 year. So the assets of Bank Alpha obviously change at that moment, and instead of having 100 ounces in gold coin, he only has 20 ounces. And he says, okay, I'm taking your 80 ounces and I'm going to lend it to someone who wants to borrow it. And hopefully Bank Alpha is suitably good enough to know who the money should be lent to. That is the role of the banker. You have to be a jack of all trades and master of none. So it will have 80 ounces here, an 80 ounce bond. Okay. So we went from having no bonds because everything was on demand to a bond. Okay, so we're going to put that bond here. Right. But those 80 ounces were lent to whoever. Let's say James. And James used those 80 ounces to build obviously you're not going to build a factory from just one person is not going to come to you and say, here's a factory, give me 80 ounces. You know, it will be many people who build the factory. So you'll have to bear with me on this. But the point is that a set of people or one person, a set of people in aggregate or one person will now have 80 ounces. Because these 80 ounces have been spent and they've gone into the pockets of other individuals. Is that clear?
Yeah.
Okay. And you've got the bond. The bond which... the bond. Now, those 80 ounces, assuming it was spent in just one person's pocket rather than a collection of people, because that's going to make the drawing a bit messy, ends up as a demand deposit from John in Bank Beta. 80 ounces. And John says to Bank Beta, I actually want to keep it all on demand for the moment as well. So at that moment, Bank Beta will have 80 ounces in gold coin. And then John goes through the same thought process as our chap here, because he's allowed to, and says, I'm going to keep 40 ounces on demand deposit. And I want to lend out 40 ounces. So in a similar way to Bank Alpha, Bank Alpha keeps 40 ounces in gold coin. And lends 40 ounces out just like Bank Alpha did. Okay, and this is the same 100 ounces of gold in this example here. It's not different gold, it's the same gold circulating in the system. So, Bank Beta lends it out, and you have another bond. My goodness. Bond with the guarantor or underwriter as Bank Beta. And then in the same way, okay, as John had 80 ounces to deposit in Bank Beta, someone will have 40 ounces that they didn't have before because 40 ounces has just been spent. And they do exactly the same thing in Bank Gamma. So let's name these people. The first one was, to make it so, John, Tony, and Matilda. So Matilda now has 40 ounces herself, and she says, split it 20-20 in demand time and lend the rest out. And Bank Gamma goes, okay, fine. So Bank Gamma keeps 20 ounces in coin, and lends 20 ounces out. But we've also got another bond now. From who? From Bank Gamma, Matilda's bank. And so on. Dot, dot, dot. Rinse and repeat. It's an iterative procedure. Okay? And so it can quite clearly be seen that. So this was an 80-ounce bond, and notice the arrows denoting movement. This is all about movement, circulation. Okay, so bond alpha is of 80 ounces. Bond beta is 40 and 20, and that adds up to 140. Okay, so we've got 140 ounces worth of bonds in circulation, or bonds, or 140 ounces worth of time deposits, plus the original 100 ounces of gold. And if you want to represent this in higher order money terms, you'd have your gold here, and you would have your M2 here at 140 ounces. And within, and assuming that was left like that, okay, at the end of 2 years, what would happen to this? Let's say they all lent out the money for 2 years and everything's okay in the economy and everything gets repaid. What happens to this? Disappears. Okay. It disappears. So that's the way the people arrange themselves. Okay, and I put banks around each of these processes because that's where these processes usually take place. They can take place underneath a tree. You know, they don't need to take place in a bank. So another point to make before I go on to how we evolved from this arrangement. If M2 is doing that, how many people would say, well, that must mean that there's no economic growth? Would it be a cause of concern to anyone? Because a lot of people think it should always do something like that. Okay, the point is that even if M2 is flat forever, M2 represents liabilities between X and Y, let's say 1 and 2 years payoff. The same M2 here, by definition then, is not the same M2 here, because this would have expired by the time you get to here. So a flat M2 actually hides the actual nature of the circulation that's actually going on there. And you can imagine that people that actually want M2 to do this, you know, they're crazy, you know. So a flat M2 actually hides a very high degree of, is actually it's like a one point representation of the amount of movement that's going on for that particular frequency of that particular duration of monetary asset. Okay? So this is all driven subjectively at each stage by the protagonists in the financial system, or the system. And what we have now is basically when John goes into Bank Alpha, it's regulation that decides how much the bank needs to keep on demand deposit against lending out. So if John wanted to come into the bank and only lend out 80, regulations would say, well, you only need to keep 10. You know, it's the law. You know, it says, you know, you can keep 10 if you want to. So John's subjective preferences would have been usurped by regulation, and the guise of the regulation is to protect the banking system. But it's not. It's actually distorting John's personal subjective preference. And you think, okay, yeah, you can do that, I suppose, and that is fraudulent because you're invading personal property rights. But what happens if John, let's say you've lent out 90 instead of 80, but John thinks that he's got 20 on demand, he's actually only got 10, you know, that could cause a problem for me, says the banker, you know, to his other banker friends, with the regulator. And the regulator goes, that's all right, don't worry. I'll set up a central bank. And the central bank will take as collateral all of the things that you need to monetize. Does anyone know what kind of transaction that's called? A sale and repurchase. So, in order to compensate for the distortions that have been brought in, whether intentionally or not, the central bank is there. Okay, because you can't say to John, when he comes for his 20, here's 10 plus a bond, you know, or a bill even, you know. He wants the cash. He wants the cash. Okay, so to hide the fact that John would be getting a bond back instead of gold coin or money, you know, the 10 would go from the bank's balance sheet, the 10 ounces of these bonds which have now been created because you're sticking to regulation, will end up at the central bank, who will then furnish our chap with the 10 that he needs. So is that all clear? I think it's clearer than the previous example. Okay, so that's the way it's meant to work, and this is the way we are currently, with the central bank just accepting assets. Now the central bank obviously has a problem because they need to to buy a lot more assets, than they previously. I say assets; it's obviously not an asset, but they need to buy a lot more assets in order to keep the deposit system from just fracturing and causing the worst depression, deflationary depression that you can possibly imagine. Because all of you guys that think that you have $100 in XYZ bank, you don't actually. You never did. So just remember that. Bailing out the bankers is actually bailing out us as depositors in the financial system. Okay. On the back of that, any questions?
Several questions to comprehend this completely. Now, let's to your example how it should be without the central bank. First simple question: the IOUs, which you call bonds, they are not part of the money supply, correct? You can't pay anything with them. Payments are made only with gold, with a stock of 100 ounces.
Yeah, I mean, you can try and pay with a bond. Someone might accept it at a discount, but gold is the ultimate extinguisher. Yeah.
So theoretically, it could be that that in the system there's absolutely no credit outstanding. Like you have 100 ounces of gold and 140 ounces of credit bills, or how you call this thing. But you can imagine that nobody gives them a credit, that only money sits in the deposit and is used for payments. So theoretically this could be.
But payments, again have their time scales. Is it an instantaneous payment? Payment for what?
Well, somebody buys something from somebody else. So I give an order to my bank and say, take so-and-so many grams of my gold and transfer it to the account or at your bank or another bank of the person I owe the money for. Okay? That's what I consider to be payment or transaction.
Yeah.
And theoretically, only these types of transaction could be in the system without any credit.
Absolutely.
Okay, good.
Absolutely.
Now, we haven't talked about the real bills so far, but the real bills, they do add to the money supply, correct?
First of all, I wouldn't call it money supply. Call it credit supply. Call it credit supply.
Yeah, but the credit supply which is used for payments.
The real bill is not a part of the money supply, because again, if you look at total bills outstanding as a particular measure, it will be, let's say, something like this. Okay, but that bill would have expired because the produce that it was used to finance has gone off the market. So the bill market is like an expression of...
Okay, but nevertheless, you could, again, make payments without any real bills, only with the gold. But in the very moment when a real bill is issued, there's more, so to say, money in the system than gold. Because it's not a whereas, the bonds, or the credits, or how you call it, they are not used as money. You don't make payments. You said you could try to, but that doesn't occur. So it's just, it's wealth, so to say. It sits in your deposit. You don't use it for payments, Whereas a real bill is used for payment, and it's created, so to say, which I think is completely legitimate, so that you don't get me wrong, out of thin air. The person who issues the real bill doesn't have any gold. He could make a payment with gold, as we said it before. If he has gold in his deposit, he could make a payment in gold, but he doesn't make it. He issues this real bill and uses it for payment. So it adds to the money supply in the sense of money that chases commodity or bargain or services or whatever?
I'll let my chairman answer this.
Can I answer that?
Yes.
It is not created out of thin air. Absolutely not. A bond is. A bond is created out of thin air on the expectation.
No, a real bill.
I'm talking about a real bill. I'm comparing it to one. He's talking bonds.
Yeah.
A real bill is issued when real merchandise arrives at the retail store.
Yeah.
There is a tanker full of gasoline,
Yeah.
real material stuff already there, ready to be sold to the consumer.
Yeah.
So it's not thin air. Without the actual
As I'm
product,
saying,
there's no real
I don't
issue.
criticize this. I'm
Well, I'm trying to, when you said out of thin air, no, it's not out of thin air.
Well, why then doesn't he pay in gold?
Because he doesn't have the gold yet.
Exactly. He doesn't have it, so he creates it. He creates an obligation or IOU on something he doesn't have yet.
No, that is not right. Let me give my example, if I may take a minute. A fuel truck arrives at the gas station, at the retail gas station, with 30,000 liters of gasoline in it. And that, in Canada, it's about $1.30. So we're talking about $40,000 or $50,000 worth of fuel. Now, do you expect the gas station attendant to pay cash? I don't think so.
No.
Do you expect him to write a check for $30,000 or $40,000 or euros? No. All he does is sign a piece of paper that says, yes, we have taken delivery of this real product, this gasoline, and we obligate ourselves to pay it in 30, 60, 90 days. It's commercial credit, it's terms.
Okay.
And the terms are granted by the wholesaler. The wholesaler says, yeah, we're going to deliver this gas because we know you can sell it, you will sell it, so we're assured of payment. And that's the difference. And the gasoline itself pays the bill. The gasoline exists. Now his warehouse doesn't exist yet. And it may or may not pay off.
So it's only a way of clearing, so to
It's
say.
a way of clearing. That's exactly what it is. And it's a huge difference. It's just not the same at all. And that's why there's no borrowing, no collateral, no lending. Let's suppose, I talk about collateral, it's cabbages. Cabbages arrive, and are the cabbages collateral? But by the time you would have to pay them, they're rot. So it's not collateral, it's trust in the fact that people will buy the cabbages.
And then let me play the Avocatus Diaboli. What's wrong about me issuing, let's not call it real bill, because it has a longer duration, IOU of like, say 2 years. I write a paper and say, in 2 years, I will pay you so and so much.
I understand that.
And if somebody accepts this as a payment, and again uses it as a payment as well, because everybody knows that the man who wrote IOU, everybody believes he can pay in 2 years.
You have to follow professors writing about bills of anticipation. These are fraudulent. They are not real bills. You know.
No, but I don't call it real bills. But
Well,
what's wrong about
and
it?
don't call them that. They're not real bills. They're promises. They're bonds.
What's wrong about it?
And they won't be accepted. But who's going to accept them? That's the point. The market itself
Okay, so
decides.
practically, so you say practically they wouldn't be accepted,
That is correct.
but the jure, nothing is wrong with it.
With what?
It's Siemens.
Law, I think is the word you're looking for.
Jure, how do you say it in English? De jure.
Law. De jure is law.
Law, yeah, sure. It's not fraudulent. It's simply that it would.
It is fraudulent if you call it a real bill. Absolutely
No, I
fraudulent.
wouldn't call it a real bill.
That's
I call
fine.
it an IOU.
But then you go out and you pay the rate of interest and you put collateral up or you do something to get that loan. It becomes a bond. It's not a real bill.
I've got a point here. I went on holiday a few months ago, and as a joke I said to one of my friends who's exceptionally wealthier than I am, I'd like a loan, for the holiday. And he said, well, give me some collateral then, and I'll give you a loan. So there were 3 of us going on holiday, and I said, okay. You write me a note to the other person. I said, write me a note that says you'll give me £1 million in 2 years' time. Okay, and I said, I'll write you the same note, okay, saying I'll give you £1 million in 2 years' time. So I've got my collateral, okay, and I gave it to my friend, who is a bond manager, the biggest bond manager in the world. But he accepted it on good faith, This is all joking, obviously, by the way. And he said, oh, okay, I didn't know that he owed you £1 million. And I said, well, he does. And then he got a bit suspicious, when my other friend went to him for a loan and deposited the chit that said that I owed him £1 million. So it's quite obvious to see what is wrong in doing this. You don't need to be a rocket scientist to say that this is wrong. But that's what goes on.
Okay, next question, if I may. So the money supply in the system as it should be is not expanded by issuing real bills or giving credit or issuing bonds. Now, how can the money supply expand, if I have understood it correct? Only by adding to gold, digging more gold, or as the free bankers, as me, see it, taking other commodities as base money, which is silver, copper, amber.
The only way you can expand the money supply is by mining more gold.
Okay.
As long as you define gold as money and money as gold.
Yeah. So I wonder, what really is all this crawling about with the Mises people? I mean, is it only a thing of words? Because they don't understand each other because they call fractional reserve banking something different than you do? What's the problem? I mean, that's 100% reserve. You call it fractional reserve, whatever, but it's the same idea.
I don't call it. I don't call this fractional. I like to call it just like a self-similar process. Yeah. I don't spend time reading sort of erroneous literature and research. So I don't. I've never read.
If I can jump in, I think it's more than just a definition thing. Mises people. Obviously, there's quite a number of them, and I don't necessarily think they all agree with each other on all points. But they assert that fractional reserve banking is when the bank takes in $1 and issues $10. The bank is literally creating 10 times the money that was deposited at it, which is just simply wrong, which just simply is not true. So they want. I think he's going to disagree with me on that.
Yeah, I'm a Mises person, so I've been there twice, and I know the guys, and I think they say, no, if you deposit $1 in the bank and it loans out 90 cents.
That's correct.
That's what they call it.
I've seen so many of them, or at least people that are affiliated, saying
They're
this.
full of shit, don't worry.
Well, I know, but there's a lot of that out there.
Yeah.
Yeah, but Alex, that is not fraudulent. I mean, the amount.
Yeah, now let's say you go to the bank, and that's the thing. If it's not consensual, if you believe, if you throw $1 into a bank, and it's a demand deposit, and you think that you can redeem it at any time, and they loan out 90 cents,
Of course, that's fraud. That's an invasion of property.
Yeah.
So what's the problem?
Why don't we call one fractional and one fractal banking?
It's only a question of words, but not in.
They're also opposed to real bills because they're interested in the total quantity of money, which they define as inflation. So anything that adds to credit or money, they're opposed to on the grounds that that's inflation.
So that's what it boils down to, only the real bills.
Well, and when...
Can I answer that, please? I've communicated with the Mises Institute, Bloomberg, one of the guys there, about this, that the professor was on this side, and they were on the other side, and I said, what exactly is wrong here? And he didn't understand what real bills were. Did not understand how they work and how they come into being and how they disappear. And once we went back and forth a few times, and in all honesty, said, well, we're really on the same page. This is more of a disagreement, and that is it. When I first started to study this whole issue, the professor's writing started off with the second greatest story ever told. The first being the Bible, the second real bills. And I had no clue. And I started to read and study this, and I said, boy, that's obscure. And boy, it's important. Wow, no wonder people don't know. This was the first thing to disappear. This disappeared before World War I. And it's been 110 years. And yet this is the most vital function of the gold standard. It's not just gold. There have to be the bond leg and the real bills, that those three legs, if you will, are the foundation of the economic system that can work. And that's why people don't understand it. And once they take the trouble to understand, well, it's real goods, and there's no collateral, no borrowing, and the sale of the good itself liquidates it. And another thing, if there are no orders for new goods, the bills are not replenished. That M2 up there with the wiggles that Sandeep drew, this is called an evenly rotating economy. It's a fixed dynamic. As those bills, or those bonds in this case, mature, new ones replace them at the same pace. So nothing changes, but underneath the churning is going on. Now if that chart goes up or down, that means there are more bonds per dollar, the velocity picked up or went down. Think about real bills as the manifestation of the velocity of money that people spend. The more they spend, the more bills must be drawn because there's more goods being consumed. And if the consumption of goods goes down, the bills mature and they go away, they disappear. So then your chart changes, and your longer term one as well.
To be fair, I don't know who Bloomberg is.
Blumen.
Don't ask me names.
Don't know,
Ask me principles.
just to be putting out there, I don't know who he is. And I've never investigated real bills, and as Adam Smith mentioned them before I got here either. So, just putting it out there.
Robert Blumen, isn't it?
Yep.
I've got them out somewhere, so if anybody wants to see them, I can probably dig them up.
Yeah.
But it's interesting that it's a misunderstanding, and a lack of understanding of what's going on. And that's why the professor's work is so important. How many people in the world really understand this thoroughly? Not too many, maybe some of us here.
And I think there's another question which needs to be addressed or to be discussed. How we make the institutional setting, or how shall I put it? I mean, what I can picture is that maybe for transparency reasons, it might be wise to have two kinds of banks, to have this credit business in a completely different entity, which might have the same owners as a deposit bank, but doing it within the same company is, for transparency reasons, might be not so wise. And take the e-gold system. They actually did it this way. They had the e-gold company, which was only for deposits, and they founded another company. I think it was gold and silver, GSNR or something like this. And this is where you would transfer your money to from the e-gold bank, if you wanted to loan it to somebody else.
Okay.
So
I mean, we did have that because commercial banks would only, the longest maturity deposit you could make would be 90 days, because the commercial bank was restricted to only buying real bills of exchange. And then the merchant bank, can take in deposits as well, but would extend credit that is not necessarily self-liquidating by any measure, and obviously has a duration which would be longer than 90 days, however long you want to put the money to work for. So what Glass-Steagall,
yes,
so that there was an element of that there, and that was cut away in, when was it, 99?
Clinton.
Not too long ago, just before the big crisis hit.
Yeah.
Another coincidence.
Another coincidence, And then you could mix demand deposits, and forget about putting demand deposits in bonds. God knows what they put demand deposits in, sort of during the past 10 years since.
Just one more point on the central bank. When I was a kid, they taught us in high school the lender of last resort. And it's kind of like, thank God there's a lender of last resort. We are saved. Well, it took me many years to figure out that What happens when the lender of last resort is tapped out, has no more credit? Then it's the treasury and the taxpayer and so on. And of course, when you're talking about real money, gold, there's no need for a central bank. How can they send out more gold than actually exists? Impossible, and that's the discipline of gold. So the central bank can only do its thing in paper. Mr. Bernanke doesn't like this idea.
Yeah.
Why?
Yeah. You know, so there we go. And this leads into my second lecture. Okay, so I'm just going to quickly cover something that Professor has already talked about. There's a bid-offer spread in all entities, as you're aware, and the interest rate has the floor set by marginal time preference and the ceiling by marginal productivity. Marginal time preference, marginal productivity. And there might be a market maker in between. So marginal time preference tends to push the floor down. Marginal productivity tends to push the interest rate up. Let's say this is 4.25 off a bid, 4.5 bid, 4 3/4 offered. And the market maker sits in the middle here, if a market maker exists, trying to close the spread that way. Okay, so just remember this. Just remember this. Full stop. I mean,
that's the investment banker, right?
that would be, yeah, that would be the merchant banker. You know, depending on what time frame you're talking about, you know. Because this plays heavily in the gold market, and the concept of basis and co-basis, contango and backwardation, links in very heavily with this observation. Are there any more questions? Wow, okay, I think that we should call it a day then. Okay, thanks very much.